talk about India's tryst with tax on indirect transfers through his legislative maneuvers, especially Section 911 amendment. The discussion will evoke teachings from the profound judgment in Sanofi Pasteur's case. To make the talk contemporary and forward-looking, the experts will also delve into the multilateral instrument, that is the MLI, and decode the stretch of the principal purpose test vis-à-vis taxation of indirect transfers. And they will also analyze as to what lies in store for MLI's Article 9 for cross-border share transactions. With this, it is my delight to welcome our esteemed moderator and panelists to the dais. I would first like to invite our moderator, Mr. Vaibhav Gupta from Dhruva Advisors LLP. I would now like to invite our panelists, Mr. Kamlesh Varshni, Joint Secretary, TPL1, Ministry of Finance. I would also like to invite Mr. Mehul Beda from Dhruva Advisors LLP. To quickly introduce our moderator, Mr. Vaibhav Gupta is a fellow member of the Institute of Chartered Accountants of India and is based in Dhruva's Delhi office and has more than 17 years of experience in mergers and acquisitions advisory services. He specializes in transaction tax and corporate restructuring advisory, including complex tax and regulatory issues. He has also advised large Indian and multinational corporations on diverse transactions such as acquisition structuring, business consolidations, hive-offs, succession planning, cash repatriation exercises, and limited liability partnership services. He has also been a part of large, complex, cross-border as well as domestic transactions and has advised several large listed and unlisted companies on joint ventures, private equity fundraisers, strategic sell-offs, and more. Prior to joining Dhruva, he was associated with BMR Advisors and PwC in their M&A practice. With this, I now hand it over to Vaibhav to kickstart the second panel discussion for today. Over to you, Vaibhav.
Thank you. Thank you so much. Good afternoon, friends, and welcome back after such a sumptuous lunch. Well, we've tried to curate for you a very interesting discussion on indirect transfers and its taxability in India. And maybe before we really move there, maybe we can look at how this entire thing has evolved in India. Post the 2012 Supreme Court judgment, where Vodafone won the long-drawn litigation, and Supreme Court held that India doesn't have the taxing rights to tax indirect transfers, the government brought about an amendment in 2012 to Section 911, and it was inserted that any gains arising from transfer of shares of a foreign company which derives value from India will henceforth be income deemed to accrue or arise in India and hence taxable in India. And they made it applicable retrospectively from 1961. Now this, of course, led to a huge hue and cry, particularly the part on the retrospective applicability, because effectively it sought to bring into litigation, all transactions which were done from 1961, right from 1961 onwards. So in 2015, when the Modi government came, the government was prompted to bring in another amendment wherein they prescribed the de minimis transaction thresholds and also prescribed that how will a foreign company be deemed to derive value from India, and they prescribed the substantial value test, which we call the 50% test. So effectively, it was inserted that only a foreign company which derives at least half of its value from India will be treated as a capital asset situated in India, and hence a transfer of such capital asset will be taxable under 911. Similarly, the small shareholder exemptions were also brought in the 2015 amendment, wherein shareholders holding not more than 5% shares were exempted from the applicability of indirect transfers. If we go back just before that in 2013, we saw the famous Sanofi ruling from the Andhra Pradesh High Court, which was a positive ruling which held that for an indirect transfer, treaty benefits are available. And this was in the context of the India-France treaty. And we'll talk about it in detail as we move forward. Then came 2017, and we saw the Kane Income Tax Appellate Tribunal negative ruling, where the benefits of treaty in the case of an indirect transfer were denied, and the department sought to levy as much as $1.5 billion in taxes from Kane. We all know Kane subsequently invoked the bilateral investment treaty, and there was an arbitration in the International Arbitral Award. It was held that India had failed to uphold principles of fairness and equity under the bilateral investment treaty. Impacted by all of this, in 2021, then we saw the amendment which sought to repeal the retrospective applicability of the 911 amendment, and it held that only transactions from 2012 onwards will be covered within this amendment. In June 2020, we had again seen an advance ruling in Tiger Global, where again it was held, and this was in the context of a Singapore transaction in the case of Flipkart, and we'll again talk about it in much more detail as we move forward. But what was held in the advance ruling was that providing treaty benefits on indirect transfer transactions is perhaps not even the objective of the treaty. And this is, of course, in the Delhi High Court, and time will tell as to how it unfolds, and we'll discuss more about it. But the 2021 amendment probably sought to give us that respite to at least say that it is not retrospectively applicable, it is only applicable since 2012. It, of course, came with certain conditions on the taxpayers having to give up their rights and remedies and having to withdraw all their pending appeals. And subsequent to the 21 amendment in 22, the government itself withdrew its appeal in the Sanofi case from the Supreme Court. So that has really been the evolution of this entire indirect transfer and the jurisprudence therein. And maybe with that backdrop, Mr. Varshney, sir, if I could come to you, and the first question may be to, from a policy point of view, sir, why do you think a state really should have or would want to retain taxing rights on indirect transfers? So if you could throw some perspective on that.
Yeah, so that's a very good question. In fact, that is how we should start with. That why is that countries like India want to have a taxing right on indirect transfer, capital gain on indirect transfer of offshore assets? But before that, we need to understand why even direct transfer. Why do we want source country to have that taxing right? We all know that it is not in OECD model, but Indian treaties have it. Some treaty did not have it. We have amended those treaties, and now only very few treaties are left with some kind of a carve-out, like Netherlands Treaty, Korea Treaty is there. So very few treaties are left now. Now, in all treaties, we have a taxation right for India, source country, for capital gain. So first I am touching capital gain on direct transfer, then I will come to indirect transfer. So the developed countries always feel that this taxing right should be with them. However, the developing countries feel that taxing right on capital gain should be with the source country, because what is capital gain? Capital gain is whatever gain which has been earned, which has not been distributed, number one. And number two, unrealized gain. That means you have assets who have increased in value, whether tangible asset or intangible assets. So that is unrealized gain. So for undistributed gain, their argument is that tomorrow it is going to be distributed in the form of dividend, and you will get it. You will get your tax. So source country right to tax dividend income, it's already there in all treaties. Rates may differ, but that right is there. So you will get your tax, and if you tax capital gain now, you will end up into capital loss situation. So the response of developing countries was that in a going concern, this situation will not arise, that because you have taxed capital gains and after distribution of dividend, you will end up in capital loss situation. That is point number one. And point number two, the unrealized gain is something which will never make this situation happen. And that is something which needs to be looked at. If you have earned capital gain because assets of the company have increased in value, then who has contributed to those increase in valuation? Whether it is location specific factor or whether it is holding company specific factor. If you see, if the value of tangible assets which are located in India, companies located in India, and all its assets are located in India, if that value is increasing, it is because of local specific factors like local infrastructure, local demand, local license, and all those factors. And therefore, the taxation right of capital gain must be with the source country. Now, that is the basic philosophy why India has always been on source country taxation of capital gain. Now, once we agree to this basic philosophy, the taxation of indirect transfer automatically flows. Because just by putting an intermediary company somewhere in Mauritius or Netherlands or Luxembourg, the gain which has accrued in India will not shift to those countries. So those gain will remain here. So whether you transfer the share of Indian company or whether you transfer the share of its holding company in offshore jurisdiction, it is the right must remain with India. So that's a basic philosophy why from tax policy perspective, India is of a view that the taxation right must be with India.
Thank you, sir. Maybe moving on from there, Mehul, if I could come to you. And we saw the Sanofi ruling, the Andhra Pradesh High Court. There was a negative AAR, and then it went to the High Court, and we saw a positive judgment. Would you want to throw some light on this ruling, and what are the learnings therefrom?
Sure, Weber. So just so that the audience is clear on what was the Sanofi ruling exactly, and remember that this had come right at the at the inception, almost at the inception of this whole thing around indirect transfer. So when there was this 2012 amendment, this ruling came in 2013. So it was quite recent in that sense. There, the fact pattern was that there was an Indian company called Shanta Biotech, and Sanofi was buying that company plus some other companies in the group. There was this French company which held about 78% of this Indian company. And the shares of the French company were being transferred again by a set of French shareholders or companies. So really, what a position was taken by Sanofi and Shanta Biotech was that this is a transfer of a French company by French shareholders. And therefore, one has to look at the India-France treaty because the selling shareholders were French. If you look at the India-France treaty, and there are several such treaties like India, Netherlands, and some countries in Europe, there is this provision that says that gain from alienation of shares of a country, at least 10% of that will be taxed in that source country. So as Mr. Varshney was mentioning, it does say that the gains will be taxed in the source country, provided you meet that minimum threshold of 10%. And then it goes on to say that if the gains are not taxable in any of the 1, 2, 3, 4, and of course the source related taxation is in that 1, 2, 3, 4, then there is a residual clause which says that then it will be taxed, any other gains will be taxed in the resident country. So Sanofi took shelter of that clause and argued that under that clause, because shares of an Indian company were not transferred, so shares of a company incorporated in a contracting state, which is India, is not transferred. Therefore, it should not be taxable in India. The authority of advanced ruling was negative on this point. And then it traveled to the Andhra Pradesh High Court, which ruled in favor of Sanofi and said that yes, treaty benefits are available. And it also went on to rule that there is no case here of any tax avoidance or anything of that sort, and that this should not be taxable in India. So that's a brief summary of the Sanofi ruling.
Great, thanks, Mehul. So on this related point, Mr. Varshney, to bring you in, So we saw the Sanofi ruling and we saw what the Andhra Pradesh High Court held. And then there is this Tiger Global ruling, wherein there was a Mauritius company selling shares of a Singapore company which derived value from India, and this was in the context of Flipkart Walmart transaction. And again, the advanced ruling was negative. And the ruling, in fact, went on to say that providing benefits under the treaty in the case of an indirect transfer is perhaps not even the objective of the treaty. So, how would you really distinguish a Sanofi versus a Tiger Global, sir?
Yeah, I think, yes, I will try to reconcile the two ruling. But before that, I will just make an observation that it is not positive or negative. You know, that ruling is positive, ruling or negative. That reminds me, there used to be, some other agency, not Taxsutra, somebody else who used to, every day used to give a judgment, just like you see Taxsutra giving judgment every day. And then it used to put a red flag and green flag. I phoned them that what is this? What is red flag and green flag? Green flag when it is in assessee favor, red flag when it is in revenue favor. So there is nothing like positive or negative. I mean, we should go out of that mindset. It is whatever courts are deciding as per their wisdom, what is the correct law, correct interpretation, and it could be in revenue favor or it could be in assessee's favor. So that is how we should look at, and we should try to learn from those judgments, how do we reconcile those two judgments. So 2 points I would like to make, that whenever there is an indirect transfer, 2 things which you should look at. One is whether there is anti-avoidance. Number 2, interpretation of treaty. Now, if on any of these 2, if taxpayer is not able to satisfy the assessing officer or the court, then tax treaty benefit may be denied. And I will explain how. So, first of all, tax avoidance. If you read OECD commentary, Article 1, it clearly says that the purpose of DTA is not to create a smoke screen or to create a colorable device to take advantage of tax treaty. And it says it is not dependent on your MLI or anything. If you read para 61 of Article 1, it says that what this provision, this principle that tax treaties are not to be avoided, you can't create a colorable device or smoke screen, is independent of whether tax treaty has MLI or not. PPT or not. And PPT only confirms this principle. So even if PPT is not there, this has always been the position of everyone, that you just cannot avoid payment of taxes or take advantage of tax treaty by creating an artificial entity in between. So this is what has to be decided. In Sanofi case, on the facts of the case, it was decided that there is no smoke screen, there is nothing, there is no colorable devices. And one of the very important point, I think, in that Sanofi case was that they paid capital gain tax in France, which was even higher than what they would have paid in India. So that was a very, important fact which should be kept in mind. In the case of Tiger Global, the court was not satisfied with the facts, how it was presented to them. And there was one more issue. They were only deciding on 245(2). That means prima facie whether it is avoidance or not. Not a complete conclusion that it is a tax avoidance. Even prima facie, it appears that it is a tax avoidance, AAR can refuse to give its ruling. So that is the ruling they gave in Tiger Global. And they on the base, once again, basis facts, they said that it is Mr. Coleman who has all the authority, and the Mauritius people don't have an authority. So that is point number 1, depends on the facts of the case. Being a taxpayer, tax professionals, you must have sufficient information, document to substantiate that there is no tax avoidance, there is no colorable device, there is no smoke screen. That is point on you. From us, our side, tax officer have to demonstrate that there is a smoke screen, then only he can deny tax treaty benefit. The burden of proof may differ whether there is a PPT or not. I will cover that later, but the position remains same. That is point number 1. Point number 2 is interpretation of tax treaty. In the case of Sanofi, both the entity were in France, so only one tax treaty was involved. The revenue argument was that Article 13.5 is also looked through, has indirect, because over 247, when in 2012, the amendments were made for indirect transfer, section 247 was also amended. And it said transfer include indirect, direct, voluntary, involuntary, all type of transfer. That means even if the shares of Indian companies are transferred indirectly, 13.5 kicks in. This is the argument which was taken by the revenue, and court came to conclusion that this is not true. By amending your domestic law, you cannot override the treaty. There is a New Skies judgment also, Delhi High Court. I have a different view on that. I think that is not the correct view. If you read Article 3.2 of OECD commentary, 2010 commentary, it says it is an ambulatory approach. If you go to the domestic law, then the definition as exists on the day of application of treaty is to be seen, not on the day when treaty was entered into. Is clearly written in OECD commentary. When in 2017 they revised Article 3.2 and included that part in 3.2, even then, when they revised the commentary, they said that this is the position even otherwise, even if it is not in the article, because this has always been the position that 3.2 has an ambulatory approach. Now, that's a different matter, that a court could have come to same conclusion if it would have looked at UN article, because UN Model Tax Convention has in 13.5 direct or indirect word written there. So that means there could be an argument that indirect transfers are not covered under 13.5, but the way Andhra Pradesh High Court arrived at that judgment, I have my doubt on that. So that is point number one. Point number two is Tiger Global. Tiger Global also was analyzed by AAR. Very interesting. In Tiger Global, the two companies are not located in the same country. Mauritius company transferred the share of Singapore company, which was holding assets of Indian company. This creates complication. Now you look at Mauritius Treaty. Mauritius Treaty, now, before looking at Mauritius Treaty, if I am the assessing officer, I will say that gain has arisen to Mauritius entity. I want to tax you because my local law says indirect transfer is taxable in India. What will Mauritius entity will come and tell me? That no, I want to take advantage of India-Mauritius DTA. I say, okay, let us look at India-Mauritius DTA. Then there is a circular. Because only 2017 it was amended. Before 2017, there was no taxation right to, there was no mention of capital gain on transfer of securities. But there is a circular. There is a circular, I'll tell you the circular number. Probably I don't have it here. Circular number. Circular number 682 of 30th March 94. That says that this only shares of Indian companies transferred by Mauritius resident will not be taxable in India, and because it is also not taxable in Mauritius, so there will be no taxation. It clearly says. And when 2017 Mauritius Treaty was amended, then what does Mauritius Treaty says? That share taxation right is with a country whose company it is. That means if it is Mauritius company, taxation right is with Mauritius. If it is Indian company, taxation right is with India. It doesn't say anything about third country, Singapore. So where is the treaty benefit? There is absolutely no treaty benefit here. It would have been a different case if Mauritius company shares had been transferred, or Mauritius company had transferred the share of another Mauritius company holding Indian assets. But because it was Mauritius company which transferred asset of Singapore company, now see, Sanofi judgment also said the same thing. What did Sanofi judgment said? It did not accept revenue argument when revenue said that it is not France company share which are transferred, it is Indian company shares which are transferred. It said no, it is France company shares which are transferred. Now same argument of Andhra Pradesh High Court you apply to Tiger Global. It is Singapore company share which are transferred, not Indian company shares are transferred. So where is the treaty benefit of India Mauritius? I think that's a clear-cut case in my view. Even if it goes to High Court or Supreme Court, what happens on avoidance, I don't know. But on this legal interpretation, there is a very, very strong case for revenue. That's my view.
Thank you. Thank you, sir, for your honest views on this. So Mehul, let's talk about PPT. So now we know that there is PPT and post MLI. We need to really look at the principal purpose test of a transaction or an arrangement. And the way PPT is worded, it seeks to say that, the treaty benefits can be denied if it is held that one of the main purposes of the arrangement or the transaction is to derive treaty benefits, unless, of course, providing those benefits are in line with the object and purpose of the treaty. So if you were to look at a couple of situations here on the screen, and if you were to try to decode these situations from a PPT perspective, right, and how can one look at whether principal purpose test is satisfied in one situation versus the other, maybe if you could throw some color on that, Mehul.
Yeah. So I think, as Sir also mentioned, it is important to see the entire fact case. I think sometimes, like for example, now in this situation, there are two Singapore companies, one below the other, and they are holding shares in an Indian company. And it's a given fact that more than 50% of the value of the Singapore company 2 is derived from India. Now, the fact pattern here is that Singapore company 1 transfers the shares of Singapore company 2. Now, how would you look at the principal purpose test here? Of course, the point here is that if you look at the treaty, and that's a separate debate we can have, that under the treaty, because shares of an Indian company are not getting transferred, it is not taxable in India. Let's go with that assumption. If we go with that assumption, then as the Singapore company 1 is transferring Singapore company 2 shares, and where do you look at for principal purpose step? Do you say that only if Singapore company 1 satisfies the principal purpose test, then we are okay? Because that is the company which is transferring the shares, and the gains are arising in that company. Do you say that? Or do you say no? You have to look at the entire fact pattern. So if you look at the wording of the principal purpose test, it doesn't look at an entity per se or the selling entity or anything. It goes by the sort of notion that you should ensure that when you are taking benefits of the treaty, it is not with a view to just avoid taxes, right? There has to be a non-tax purpose for the entire thing. And therefore, I think here it is very important that if you see situation one is where Singapore company 1 has a very non-tax reason to exist. Let's say it has funds, there are various investors coming in, and there is a pooling of funds, etc. And therefore, there is a reason for Singapore company 1 to exist. Now, Singapore company 2 is just an SPV, and therefore, the question could be whether it has a purpose to exist, and therefore, is this just an SPV created to take the benefits of the tax treaty? Versus on the other side, where there is a purpose for both the entities. One entity is there for pooling of funds. The other entity is actually having a proper board. It has people. It has taken leverage for doing the particular acquisition. And there is a lot of substance in there. And therefore, this entire structure is not driven by just trying to take benefits of the treaty, but it is for various other commercial purposes. I think it is therefore very, very important that from a factual perspective, the entire structure should pass muster and not just one entity or the other.
Thanks. Mr. Vaishnav, I'll come to you on this, and maybe a related point. So there are some treaties which have not notified MLI, right? Now, we've seen in the recent past, there have been a few judgments where it has been held that, and in the context of direct transfers, that the presence of the tax residency certificate is sufficient for claiming treaty benefits, and you really don't need to get into beneficial ownership and stuff like that. And we've got the India-Mauritius treaty where MLI is not notified. How do you look at this from an indirect transfer perspective?
Right. So, okay, let me first go to circular number 789. What circular number 789 says is that Mauritius resident has a TRC, then you accept that he is a resident of Mauritius and beneficial owner. Perfect. Now, beneficial owner itself is only a very small anti-avoidance rule. It is not a complete anti-avoidance rule. As I said earlier, you know, even if you read commentary on Article 10, 11, or 12, when you look at that commentary, it says that we have included a beneficial ownership condition here, but that is only very small condition. What Article 1 talks about, avoidance, that is much wider. There could still be treaty shopping. There could still be avoidance of taxes through colorable devices. That would be done separately. So just because you are a beneficial owner of a share, it does not mean that countries cannot look at the facts of the case to decide whether there is a avoidance and abuse of tax treaty or not. That right is still there with every country. It is clearly written in OECD commentary. And therefore, when you look at some of our judgment like Aditya, Birla and all, fine, circular number 789 is there. You are the beneficial owner, there is no issue. But if on the facts of the case, it can be said that there is an abuse of tax treaty, then courts can interfere. So that is basically a general proposition that probably needs to be kept in mind. And therefore, even if there is no PPT as of now in a Mauritius treaty, one can look at those aspects. Although burden of proof will be higher. That my personal view is that if there is no PPT, it's like general anti-avoidance. The burden of proof would probably be higher on revenue. But if there is a PPT, because it is a specific anti-avoidance, then only you have to just prove that much, and in comparison the burden of proof will be less. That's my understanding. But otherwise, revenue can always look at the structure to see whether there is an abuse or not. So irrespective of whether there is a PPT in Mauritius treaty or not, that is the understanding. And that I also said in the beginning, that paragraph 61 of OECD Article 1 also says so, that PPT only confirms the general principle that tax treaty benefit can be refused if it can be established that there is a colorable device.
And maybe also an important point to note here is that whether PPT or not PPT, we still have to look at GAR. There is domestic GAR that is already there. So for transactions going forward, henceforth, we still need to factor GAR even in cases where there is no MLI.
Yeah, GAR is always there. So that is, even accepted fact, not only in our domestic law section 90 as well as in OECD commentary, that GAR provision will apply. So I don't think there is any confusion in the mind of taxpayer or tax community that GAR provision will apply and tax treaty benefit
Absolutely.
can be denied. That is there. But I'm going one step beyond it, that even without invoking domestic GAR, even if PPT is not there in the tax treaty, one can deny tax treaty benefit on the basis of general anti-avoidance principles which are embedded in tax treaty.
So Mehul, moving on from there, now that there is Article 9 of the MLI, which seeks to tax transfer of shares of companies which derive value principally from immovable property. How do you see this in the context of indirect transfers, and how and whether this will impact taxation of indirect transfers as well?
Thanks, Weber. So I think one important point to note here is that Article 9 of MLI, of course, is there, but quite a few treaties already contain these provisions. You look at India-UAE treaty, for example. They already contain these provisions that if the value of a company is derived principally from an immovable property, then it will be taxed in the source country. So that provisions are already there. So even in the case of an indirect transfer, those provisions will apply. I think what has happened with Article 9 of MLI at least in the India context, while India has, of course, adopted it, there are very few other countries which have needed to adopt it. So, for example, countries in Europe, they already have this provision about value being derived principally from immovable property. So, they didn't need to adopt it. There are countries like UK and USA, which anyways give all taxing rights on capital gains to the source country, which is India. So they didn't need to adopt it. And therefore, to that extent, at least in India context, there seems to be, at least with the key countries, you of course cannot say about the whole world, but at least for the key countries, there seems to be limited application. Again, Mauritius has not adopted MLI completely, and therefore there seems to be limited application. I think one interesting thing, which is of course there, which was always there, but now it is being debated because of Article 9 of MLI, etc., is that what does principal mean? Again, value derived principally from a property. MLI Article 9 has now sort of said, clarified that it is 50%. And therefore that now seems to be settled. Again from an indirect transfer perspective, where the word principal is used, again the government clarified that it is 50%. So I think that seems to be now obvious way to say that if the value of your company more than 50% is derived from immovable property, then it could get taxed in the source country, irrespective of, and therefore it becomes very critical in case of indirect transfer. The other interesting thing around that is if you are, let's say, a power company or a mining company or any such companies which own large amount of immovable properties, but for business purposes, they are not exploiting the immovable property. They are actually using it for the business purposes, but they are not exploiting. Whether that would get covered under this, I think that's a very interesting and a debatable point. One would think that it should not be so. But again, there are some treaties which have clarified that if the value is derived from a business, then it should not be considered to be covered under this article. So it's an interesting proposition, and one would see maybe much more debate and litigation around this topic.
Thanks, Mehul. So, sir, would you like to add some perspective on this? Given your experience with this entire report on the platform for collaboration on tax, such as this joint initiative with World Bank, UN, OECD, etc. Would you like to add some perspective on this, sir?
Yeah, so there's like you correctly said, that there's a platform of collaboration of tax, which has IMF, World Bank, OECD, all these people are there. So they have come out with a report on taxation of indirect transfer of offshore assets. Very interestingly, they have understood and realized the importance of capital gain tax on indirect transfer, the policy perspective, which I explained to you earlier. And they have also given two options to developing countries, how they can tax it without amending their tax treaty. Because tax treaty is a difficult exercise. So first option is that they say whatever assets are transferred, so you assume that your local entity has transferred those assets and reacquired it. So just like, for example, Indian entity has a block of assets with WDV. So we have our, the way we calculate capital gain when those assets are disposed of. And so you assume that those are disposed of at market value and then reacquired. So that means they will get higher depreciation in future, but at this point of time, there will be a short-term capital gain. This is how our block of asset calculation works. That is their suggestion. And then they also said the same thing, that it is very clear that tax treaty does not prevent a country to tax its own resident. Very important point, which each one of us should note. We discuss about the interpretation of the term maybe tax, or the current latest few days back, the decision from ITAT came, applicability of DTA on dividend distribution tax. In my view, correct judgment that it is not, because no tax treaty prevents a country to tax its own resident, and it is written there in that report. So what I'm saying, of course, these issues will be decided by the courts on jurisprudence, but I'm just telling you what are the views of various experts in even international, literature. So I'm just sharing you that. That was the one proposal. Second proposal was that you bring source rule in your domestic law, which we already have. Explanation 5 of section 9 is the source rule which they recommended, and they recommended based on Indian experience. And then they said that you amended the definition of immovable property. Very interesting. You amended the definition of immovable property to include all these telecom license, extractive industry, and rights given by the government. So that means what they hinted was that Vodafone case and Kane case should have got covered by domestic amendment of definition of immovable property. This is what they have recommended. And they have also said that this, once again, that Article 3.2, when you go to the domestic law for definition of immovable property, because Article 6 says immovable property means, will take its meaning from domestic law. It means that domestic law definition as of today, what I said earlier, it's an ambulatory approach, not when treaty was entered into. So very interesting.
Thanks. Very interesting. I think this approach of saying that a Vodafone or a Kane would have been taxable had this amendment been there, or very interesting. One last question to you, sir. So we saw the 21 amendment. It was, of course, drawn with the objective to reduce litigation, but it came with certain riders, as in the taxpayers had to give up their remedies, withdraw their appeals and all of that. Do you see this amendment being successful, and has it helped achieve the objective for which it was brought?
Absolutely, hugely successful. Virtually all taxpayers have opted for it. It was voluntarily, and everybody except one or two who are non-traceable, we have also not been able to serve notice on them. That's all right. So other than that, everybody has come forward, opted for it. The purpose was that reduce the litigation, give message to the foreign investor, for about certainty. And that means 2012 amendment, retrospective part has been withdrawn, but the prospective part remains. That means today, when we sit here and take business decisions, it is applicable. Indirect transfer, domestic law is applicable. And what we discussed, whatever Mehul has said, and everybody, what we have shared here, we need to keep into mind that, structure should pass should not caught in anti-avoidance test, should not be caught in principal purpose test. You should create, it should have substance. So that is something which you have to prove by documentation, proper documentation and proper evidence. I think that is the key learning which should be, whether you go to Tiger Global case, whether you go to Sanofi case, the PPT is there or not. Only, as I said, the burden of proof might be lower when PPT is there, but still, you need to come out, you need to produce sufficient evidences that there is commercial substance in whatever you have created.
Thank you, sir. Clearly, I think there are a lot of nuances. You have to see the treaty, whether the treaty is available or not. Then there is a principal purpose test. On top of it, Article 9. I think number of nuances to factor in. However, I think the 2021 amendment, as Mr. Vashni mentioned, clearly has helped to settle a lot of nerves. But we still expect to have a lot of evolving jurisprudence on this matter. And maybe next year when we meet here again, there will be more useful perspectives to discuss. With this, we'd like to draw this panel to a close. Thank you so much, Mr. Vashne. Thank you, Mehul.
Thank you.
And thank you, everyone, for being patient listeners.
Many thanks to our moderator, Weber, and many thanks to our panelists. Kamlesh sir, thank you so much for imparting your words of wisdom to all of us, and Mehul as well, for this invigorating panel discussion today. I now request the panelists and our moderator to kindly pose for a photograph. Many thanks once again. We are now happy to move on to our third panel discussion for today on the subject of two-pillar solution, developing economies perspective. The two-pillar solution has been an unprecedented tax roller coaster. Some would say that it's too good to be true. In the Indian context, The questions are rather more refined, as India has taken numerous proactive measures to